Also, hello everyone. Today we are having our lecture on supplier management, and we are going to look at the review on the economic order quantity. We have seen already in the first semester the economic order quantity number 1, okay? We will expand today to the economic order quantity number 2, which is called the supplier model or backlog model, and the economic order quantity number 3, which is the manufacturing model. And we will look at them from a mathematical perspective. So I will start with a short refresh on the economic order quantity model number 1, because some of you are new to it. And we will then expand the whole idea to the supplier and manufacturing model in order to get a wider view of the economic order quantity number 1. Here we assume immediate delivery and production. Okay, this is the assumption that we take at first into consideration. Here, if this is time, and this is our inventory, and we also assume constant demand. Those are the two assumptions. So if this is our inventory, and this is our inventory level of order quantity, which we are going to call Q, then in t equals 0, we are going to have a level of inventory equal to Q, and then because demand is constant, is going to be going down in a line and because immediate delivery is and immediate production is possible, we have in T1, when we hit 0 inventory, we have again Q, level of inventory, and so on and so forth. Okay? This is the model. How do we look at it from a mathematical perspective? Is like this. I mean, this is known to most of you, and I'm only repeating this because of the new attendant. So this is the mean value or average value inventory equals Q divided by 2. And here we're going to use certain parameters. Which are as follows. D is the demand. Measured in parts per time. C is the cost per unit. Okay, measured in euros per part. A, we are going to call it setup cost. This is the money that it costs to prepare our production facility for production. H is going to be our inventory holding cost. So this is euros per part per time. Okay. And as I said before, Q is our order quantity. These are the parameters that we use in this model. So it turns out that the cost function can be described as a function of the order quantity, and it has following aspects: cost of inventory plus setup cost plus production cost. So if we take this with colors, say the cost of inventory is red or rosa or something, the production inventory, the production cost is purple, and the setup cost is green. We find that the cost of inventory is given by Q divided by 2, which is the average inventory, times H, which is the holding cost per unit and per unit of time, holding cost per unit. Then the setup cost is equals the setup cost per unit times the frequency of the setup. So 1 divided by Q divided by D. Okay, this is this time. This is Q divided by D, as you can see from the formula. So this thing is the frequency, how often of frequency of order of setup, plus a constant C times the demand. This is the production cost. Okay, C we have said is the cost per unit times the times of the units that we have. Okay, so if we paint this equation as a function of Q, we find out following. The the rosa is a function that is linear, okay, because it has Q here. So it's linear, it grows with Q linearly. The holding costs are going to grow linearly, so the more inventory I have, the more I pay. Then we have the green curve, which 1 divided by Q, or in other words, AD divided by Q. The higher the order quantity, the less setup cost I have. This is also logical. And we have a constant that does not depend on Q, C times D. Okay, the production. If we add up all these functions, we get epsilon of Q. Let me paint another color. A function that has a minimum in the optimal economic order quantity. This is the economic order quantity, because it's the best because it has the minimum cost. So this is epsilon of Q star. How do we get to this value? We have done it in the past. Either we do the first derivative of Q in Q star to 0, which leads us to Q star, to H divided by 2 minus AD divided by Q star square equals 0, which yields Q star 2 times AD divided by H. Okay, if we put this value into the formula, epsilon of Q star equals H Q star divided by 2 plus AD divided by Q star plus CD. This we make 0 because it's just a constant, and so that all the formula is easier. And then we just substitute the value of Q star into the formula. We get H divided by 2 times 2AD divided by H plus AD divided by 2AD divided by H, and this equals the 2ADH. Okay, and these are the two results that we were looking for in the beginning. Okay, this is just one very fast reminder of the AOQ Model 1. Questions, please? Other way to calculate this point is to equal both. You see that this minimum here takes place where the holding cost and the setup cost are equal, so you can say that HQ star divided by 2 equals AD divided by Q star. So this is an alternative way of calculating it. And then you can say that HQ square divided by 2 equals AD, which yields the same result, 2AD divided by H. And substituting into the epsilon of Q star, you get the same. Okay? Questions, please? So this is just a reminder, as I said. The new content comes here. EOQ2, okay? This is called the supplier model. Here, our assumptions are as follow. We accept a stock out situation in which the supplier has a backlog of orders nicht gefüllte Bestellanforderungen. Okay? Here we also accept that production and delivery are immediate and that demand is constant. These are the assumptions that we have. So a little bit more difficult than in the previous example. Okay, we need supplementary parameters. We need to know that P are the cost for not supplied orders. Okay, euros per unit. When your customer comes and you cannot supply, you might have incurred some cost. You lose your customer maybe. And S is the excuse me, is the inventory after delivery. Okay, so you have the order quantity Q minus S equals the backlog. Okay. It will be clear when I show you the curve as we had before. So let me paint the curve of the inventory. So we have here time. We have on the vertical axis again our inventory. And we start in T0 with Q, with S inventory, excuse me. Here we start with S inventory, and we allow for a backlog. Let me get this a little bit longer so that it is more clear. Time. So we allow for a backlog, which means that we can go and have negative inventory. Okay, this is S. This is the inventory after delivery, S. And this is the backlog. Warum? This is the amount of inventory that you can go below average, below the level of, this is the back number of open Bestellungen, of open customer orders. So this is T1 and this is T2. Okay? Because we have immediate delivery and immediate production, we find that again here we are up. In no time we are up to the same level as before, and then this whole thing repeats. Okay. Wait. No. Doesn't want to. So this whole thing repeats ad infinitum. Okay. This is just a model. So we are allowing for some backlog in our supplier model. Is it understood? Does it make sense? So from the when we have inventory, the average inventory is S divided by 2. So when we hold inventory, we have S divided by 2. T1 is S divided by the demand. And T2 is Q divided by the demand, just as before. So we have a function. Now our cost function depends on two parameters: the level S of inventory after delivery and the order quantity. So it's a function with two parameters. We have the function, then we can represent it, and as before, so we have the inventory related cost plus the inventory holding cost for whenever we have inventory. Then we have the backlog cost when we cannot deliver to our customer. Then we have the setup cost plus the production cost. So here you notice we have an additional level that it's related to not being able to deliver to the customer, which is this backlog cost. We didn't have this before. Okay, this is this area where we are not able to deliver. Okay. So what do we have then as a function? Let's do it slowly. Okay. H are the costs per unit, and as before, we multiply it by the average inventory, and then we multiply it by the time, the frequency that we are taking this into consideration. So S divided by S divided by D, T1, and D divided by Q, the frequency, plus the backlog cost, P, the cost of inventory, times the average backlog level. Okay, and then again, Q minus S, average backlog level, times Q minus S divided by D times D divided by Q. And the rest is the same as before. I repeat, H is the holding cost, what it cost us to have 1 unit in our inventory. S divided by 2 is the average inventory level. Okay, S divided by D is the time it takes to consume the inventory. It's T1. And that here is the frequency, how often, so that we get the yearly value. And this is the yellow, the rosa function. Okay. Here, same logic. We have P is the backlog cost per unit, QS divided by 2 is the average backlog level. Q minus S divided by D is, so this was T1. This is the time of backlog. So T2 minus T1. And this is the frequency, how often, so that we get the overall cost. And the other two are the same as above. Okay? So, how do we get the minimum of this, the minimum cost, the optimal Q star, economic order, and the optimal level after delivery, S star. Okay, how do we get it? We get it by having the first partial derivative of the function to Q in Q star and S star equal to 0, and the first partial derivative of the function to S in Q star and S star equals to 0. So if we take the first derivative of this function above to Q star, we get to Q, sorry, we get the first partial derivative to Q of H S square divided by 2 times Q plus P Q minus S square divided by 2 times Q plus AD divided by Q plus CD equal to 0. Okay? And this should be in Q star and S star. And the next one is in Q star, S star equals to 0. So, and this yields following equations. The first one, minus H S star square divided by Q star square plus P Q star minus S star divided by Q star minus P Q star minus S star square divided by 2 times q star square minus AD divided by q star square equals 0. And the lower one, a little bit easier, HS star divided by q star minus P q star minus S star divided by q star equals to 0. Okay. If we solve this equation, these two equations, the value yields following: S star equals 2AD divided by H times P divided by P plus H, and Q star yields 2AD divided by H times P plus H divided by P. So this means that S star is the Q star of the first model times P divided by P plus H, and Q star of the second model is Q star of the first model times P plus H divided by P. Okay? So you see the economic order quantity of the second model is bigger than the economic order quantity of the first model. This is bigger of the economic order quantity of the first model because P plus H divided by P is bigger than 1. Okay? We find then this is the supplier model, the economic order quantity 3, or manufacturing model. Without backlog, there is a number 4 model with manufacturing with backlog. In this model, the assumptions are as follow. We have a constant demand. Okay. We have no backlog allowed. And now the production and delivery are not immediate. So it takes some time to deliver the product. How does the equation look like? Looks like this. So imagine this is time. And imagine this is your inventory level. You have your Q level of inventory, so your your order quantity. And we start our inventory level in 0. And while we produce, we are also consuming. So our delivery is not immediate. Let me paint this here. Our delivery is not immediate. Here we see that we have a constant demand. And here we see, because it's not vertical as before, so here we had it in vertical. You saw here we have it vertical, the immediate delivery. Here our delivery or production takes some time. So it takes time to replenish the inventory. Okay. This is going to be described in following equation, like this. This is going to be the holding cost of inventory plus the setup cost plus the production cost just as we had before. Production cost, setup cost, and holding cost of inventory. And the equations are similar as before. So here we have H times Q divided by 2, but now we don't have the frequency. Now we have 1 minus D divided by K, which K is the production rate. Parameter here, parameter K is production rate, what we know as cycle time. Okay, how fast we produce. Plus the setup cost, A D divided by Q, plus C times D. Okay, so this is this, this is this, and this is that. So as we say, the minimum is found when holding cost of inventory equals setup cost, and this is only because we have constant production cost, which is a very hard assumption, but well, this is just makes things easier. for us. So we have that h times q star divided by 2 times 1 minus d divided by k equals ad divided by q star, okay, which is the minimum. We want the EOQ. And this yields HQ star square times 1 minus d divided by k times 2AD. Okay, and this goes up and this goes up. And this means that Q star means 2AD divided by H times 1 minus D divided by K. Okay, so this is the solution. Notice that when the production rate is infinite, so is immediate, production, we get the AOQ1 model. So if k tends to infinite, we have, this is Q star of the third model, we have Q star of 1 equals to 2AD divided by H. Okay, just as a little note. Good, then we have then the cost, Q star 3. We have H times Q star 3 divided by 2 times 1 minus D divided by K plus AD divided by Q star 3 plus CD. As I said before, we turn this to 0 to make things easier for us to calculate. This equals H divided by 2 times 1 minus D divided by K times 2AD. I substitute the values above H, 1 divided D, 1 minus D divided by K plus AD times 1 divided by Q star 3, so 2AD divided by H times 1 minus D divided by K. And this equals H divided by 2 times, I bring this into the square root 2AD 1 minus D divided by K square divided by H 1 minus D divided by K plus AD, or let me bring AD into the square, I guess. a square d square times h1 minus d divided by k divided by 2ad okay. So I get some simplifications. 2ad h square divided by 2 square h and times 1 minus d divided by k plus ad h1 minus d divided by k divided by 2 h squared and h goes, 2 goes with 2. So in the end we have that our optimal level of cost equals ADH, sorry, 2ADH 1 minus d divided by q. When k tends to infinite, we have epsilon of q star 1 to ADH. So we had somewhere before. Okay. This is just 1, 1. So this is the result. We were looking for. Okay. The optimum number of production setups is given by d divided by q star, and this is d divided by 2ad h1 minus d divided by k equals hd1 minus d divided by k divided by 2 times a. Okay. The optimum length of production setup T1 star equals Q star divided by K is 2AD, just applying the formula, 1 minus D divided by K times 1 divided by K, and this is 2AD K times H, K minus D. Okay. When K tends to infinite, we have the AOQ model, because this is then T1 is 0 immediate production. Okay. So this is the theory. Now I give you some exercises. To enjoy, to prepare for the exam, I guess. Any questions so far? Any questions so far, please? Exercise. A company must deliver 1,000 products per day. When the company starts production, they can produce 25,000 units per day. Sorry, 10,000, not 1,000, 10,000. The cost to hold one product unit on inventory per year is 50 euro. The setup cost are 1,800 euro per setup. How often? Frequency? Should the company organize the setup? Please use EOQ2 for it. Okay. So the setup means each time we have a cycle. Okay, this is a setup. And they're asking for the, or we are asking, I'm asking for the frequency, the optimum frequency of the production setups. Exercise. So I leave you some time to copy. A company produces a product for several clients. They experience flat demand, this means constant demand, of 2,500 units per year. The production rate is 10,000 units per year. The setup cost is $50 per run. The production cost is €2 per unit. The holding cost is €50 per unit per year and has 30% annual interest rate. Determine the optimal order quantity and optimal size of production run. Use EOQ model 3. Okay. Exercise. The demand for water at an office is 600 liters per week. The setup cost, you know, this water that you can tap and then comes water. The setup cost for placing an order to replenish inventory is 25 euro. The order is delivered by a supplier who charges 0.1 euro per liter as transportation cost. Okay, so you need to be thinking what this means in terms of this model. This cost increases the cost of water to 1.25 euro per liter. The holding cost of water, because water loses freshness, okay? Loss of freshness is 2.6 euros per liter. Determine how often the office should replace or should order, place an order, should order water, and what should be the economic order quantity. Okay? Questions? Another exercise. The yearly demand of a product is 7,200 units. The holding cost of inventory are 1,500 euros per unit and year. This is H, okay? The holding cost H of inventory. Excuse me. So the backlog cost P are 2,000 euro per unit and year. Find the optimum order quantity, Q star, and optimal cost, Y of Q star, following EOQ model 3. Also, what is the optimum backlog, meaning Q star minus S star? Also, find the best ordering frequency, meaning Q star divided by D. Okay? And setup cost, in case you need it, is 1,000 euro, and C is almost 0. Okay, so here you have 4 exercises so that you can prepare for the exam. Okay, questions please? More information can be found in the book Factory Physics. Okay, from Sperman and Hobbs. www.profh4.com. And I guess I'm going to need to finish today because I need to go to the doctor. We will continue tomorrow. Okay, please make sure you try to look at the material today. Tomorrow will be the last class of the year because of my